And a big welcome to our live audience for the Digital Health Investor Talk show. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies boost growth, raise funding, find trade sale buyers, and create new strategic alternatives, giving you more options in today's challenging environment. You can follow me at x.com/Stephen Wardell. Our show today is on the topic of Zombicorns. What's next for funded companies with growth issues? With Ron Razmi, a cardiologist and the founder of Zoe Capital. This show is being recorded and will be included in our podcast series called the Digital Health Investor Talk Show. Subscribe to our podcast on Apple and Spotify and leave us a review. We always love getting 5-star reviews. This is not investment advice, and we are not investment advisors. Here's the format of today's show. It's 90 minutes long, and Ron and I will spend the first part discussing the news and the macro picture and some other topics. And then in the second half, we'll focus on the special topic of the day. And we'll be taking your questions throughout in the text chat. Ron, welcome to the show, and please introduce yourself to our audience.
Thank you, Steve. It's an honor to be back on the show. Last time I was on the show is when my book had come out in mid-2024. And we had a pretty lively discussion back then about the investment landscape in digital health and AI in healthcare. And now I think we're going to have an even livelier talk about this very in vogue topic. As you mentioned, I'm a cardiologist by background, but I've been on the business side of healthcare for most of my career. I left cardiology. I went back to business school and worked at McKinsey for a number of years before starting a digital health company that I was running for 7 years. We built population health management software. And most recently, I authored AI Doctor, The Rise of Artificial Intelligence in Healthcare. And we advise and invest and build technologies in this space.
That's great. Thank you. Good. Well, so in the first topic we'll move on to is just any learnings from recent conferences. And so for our audience, feel free to throw some comments or questions into the chat. But I'll dwell for a moment on JP Morgan Healthcare Conference. And I think that this was a conference of continuity, not of disruption, this current conference. Most things that had established themselves as being hot or not in the last 2 years continued to be the same. So the trend of large language models and of generative AI continues to be a very durable trend. Investors continue to be very interested in this. Companies that achieve very high valuations sustain those high valuations by entering with large language models. Pharma tech, selling into the pharma budgets, continues to be very hot. Software and programs around GLP-1 drugs, that's actually in question. That was one of the hottest categories last year. This year, there's a price shock is hitting the industry. It used to cost $500 a month for GLP-1s. Now it costs less than $200 a month for GLP-1 drugs. Does it really make sense for companies to spend a lot on programs and software around GLP-1 drugs if the cost has come down so much? The category of administrative in hospitals for billing and administrative work continues to be very hot for software companies focusing on that. So those are some of the stock market indices continue to be at record highs. VCs see a Fed cutting environment and continue to get a little spendier on investing in things after having been very cautious for 3 or more years. And they continue to expect there to be a greater consolidation environment and better IPO environment in the future, which are very good signs for VCs. So that's kind of some of the conclusions coming out of the JP Morgan conference. Ron, any thoughts on JP Morgan this year and what you're seeing affecting the tone coming out of it and any other conferences you were at recently?
Yeah, I mean, let's start with JPM, and then I'll say a few words about AI Med, which is one of the best health AI conferences. I was in San Diego this year in November. As far as JP Morgan goes, I would say the Chat GPT for health and healthcare and Anthropic announcements around your ability to upload your medical records, and then their LLM reads your medical records and provides explanation and answers questions and so forth, underlines the fact that healthcare remains a very coveted prize for any technology company. For people who think if a technology company is spending resources rolling out a healthcare offering, it's game over for everybody else, I would say panic not, because Google has had, I think, 3 or 4 different versions of Google Health. They've shut it down, relaunched it. Same with Microsoft, Amazon. Healthcare is not necessarily that easy to figure out for a lot of these hyperscalers. And the initial foray of these large language model companies into healthcare is very basic. And whether that's going to move the needle in terms of improving people's healthcare experience, we don't know, because you could have a lot of people who get worried and now they want to make an appointment to go see their doctor. They show up with a whole lot of printouts from their LLM and want to confront their doctor, and makes for some long visits. And the more real and practical side, at AI Med in San Diego in November, we heard about some of the technologies that are starting to gain adoption, such as the ambient documentation, which is one of the fastest technologies to gain adoption in healthcare, and it helps doctors draft a complete note. I think the experience with these technologies has been very positive. I recently mentioned on an appearance on Fox Business a couple of weeks ago that when I was a doctor, I was writing notes for a couple hours a day. And if somebody said, there's a technology that listens to your conversation and drafts the note for you, I would have done backflips. And that's the reaction we're seeing. It's not universal. I've actually talked to a good number of physicians who don't like it and have their own templates. The adoption rates that I've heard is around 30 to 35% when it's made available. But, you expect that to increase over time as people develop a comfort level with the technology. But this is important because some of the publications now are indicating that if you have a technology that listens carefully, picks up on every clue, every hint that the patient drops during the visit, you can have a visit that's much more productive, pick up on clues that are relevant to the patient's health that the doctor has always been too busy to listen to everything. In a future where we have an agentic workforce working alongside our doctors and nurses and administrative staff, you could have workflows automatically triggered by what the ambient AI documentation picks up. And then people could address those issues proactively and keep people from getting sick down the road. So some of the insights from these recent conferences.
Really interesting, thanks. And so Donna in our audience has asked, can you please comment on ChatGPT for health versus Claude for health? So I'll just throw in there that all the hyperscalers with their own large language models have health versions now, and we've seen them formalize them more and make them more robust in terms of functionality. Just recently, some announcements just recently. It takes time and effort for a person to master these systems. I like embracing the Google Gemini system for a couple of reasons, but one of them is that they have a giant pile of cash and they have a consumer business model, and so they're getting money in the door, revenue in the door all the time. They have cash to spend on this. Whereas ChatGPT, OpenAI, their business model is they're burning venture dollars. They don't have a ad-based model yet, or they don't have a certain amount of subscription-based revenue. And so I think Google's going to have the money to get farther, better, and then keep it richly functional at a low price for users, or free for users like me. So I like that, and they're certainly good at health as well. I also like that they're starting to that multiple hyperscalers are starting to officially declare healthcare products. Grok has one as well. We mentioned Anthropic Claude Health. We mentioned ChatGPT Health. Google has one. Microsoft has one. I like that they're enriching the functionality of those as well. And I'll just mention that way back in the day, I was one of those poor people who actually personally entered his electronic medical record in the Microsoft Health personal health record way back when. Then that shut down.
Was it Vault? Microsoft Vault?
It might have been, yeah. And then that closed down. Some people would enter information. No one ever went back and looked at it or used it, I think was the complaint. Then I entered my information again from paper to Google Health personal health record. Then Google shut its down. So I have the double crown, you could say, for having done that. But Ron, from your perspective, any comment on ChatGPT Health versus Claude Health?
Well, first of all, you made my point about these Microsoft and Google, these hyperscalers or big tech companies rolling out healthcare offerings and then shutting it down because they don't know what they're doing in healthcare. I think the capabilities of these language models, the fact that they've been developed on billions of data points and they can perform general functions in terms of reading your records and giving you an explanation of what might be going on or making some light recommendations. This would be becomes table stakes for any large language model. Um, those are consumer products. I know ChatGPT has ChatGPT for Health, which is a consumer product, and then ChatGPT for Healthcare, which is an enterprise product, which some medical centers are already on it, where you can go and ask questions and ask it to summarize a patient record and stuff. We know the systems of record, aka EHRs, are rolling out some of these features. They've announced some of these features. Question is, if Epic has given it to you, do you want OpenAI also to do any integration with OpenAI? I think it's really not known. But the big question for someone like me is, how does this impact patient outcomes? Does it create headache for doctors? Because now you got an argumentative person who read something on ChatGPT and doesn't want to listen to your expert medical advice because it's not in line with what ChatGPT said. Does it result in unnecessary visits? Does it make for more informed patients who come in and they have better discussions? We just don't know. And those of us who have practiced medicine and have seen technologies come and go usually withhold judgment because we've seen a lot of the greatest technologies ever, and this is going to change healthcare, never make a dent because of how the system is set up. But I would say I don't have a comment on whether Claude is better than ChatGPT or Gemini. I would imagine the differences are going to be at the margins, and each one of them might be a little stronger in one area versus the other.
Yeah, thank you. And Donna in our chat comments that Claude in her view is more concentrated on agentic tools for clinicians and administrators, such as prior auth tools. That's really interesting, Donna. Thank you. I think we've seen that as a strategy by Claude that I like, and it's working, which is they identify, high cost professions like coder or I think another one is financial analyst for Claude, and now also healthcare administrator, healthcare clinician. And instead of just having an LLM, they have very specific agentic tools for them that do extra steps of their job for them. So Donna's pointing out that Claude has that, whereas with ChatGPT, it's still in test mode and it's more of a consumer focus. Very, very interesting. So now we'll move on to talking about the macro environment, especially as it pertains to the innovation economy. The innovation economy is young digital health companies and the investors who back them. Here, the NASDAQ is at record highs, 23.8 thousand. I don't know anyone 2 years ago who would have thought if all you did 2 years ago is put your money in the NASDAQ, people would think you were a genius today. You would have made a lot of money. People would think you were a genius. I don't know anybody who thought it would be at this level today or have the steady rise that it has had through wars, through downturns. The Fed also today announced it was holding, I know that Trump very much wanted the Fed to continue its current cutting cycle. And instead, the Fed announced that it was holding interest rates steady at the 3.5 to 3.75 range after we got good GDP growth numbers. So it wouldn't be present day without a new fight between Trump and the Fed chairman. And so sure enough, we have a fight, this one involving possible criminal charges over fraud in the large Fed building renovation.
Redecorating.
Redecorating, yeah. So which I think people interpret as a sign that Trump wants them to further cut rates to boost the market and the economy instead of holding rates steady, which is a compromise step designed to not allow the economy to grow too fast and also to not allow inflation to get out of control again. So, and there's from friends, I hear both optimism about GDP growth and also optimism about interest rates having finally been lowered over a cutting cycle lasting about a year so far, but also a lot of concern about a specific AI financial bubble, which is what's driving the NASDAQ higher, and will it pop? And also weak job growth. So you got mid-career professionals with graduate degrees being laid off and finding that they literally don't know what is next. So the economy is not looking good for well-paid jobs in expensive cities, it seems. So, Lon, are you seeing this? And any thoughts on these macro environment news?
Well, I mean, This, as you mentioned, the quarrel between President Trump and Jerome Powell and cutting rates faster to stimulate the economy. We know inflation is this time around has been more sticky than a lot of people expected. It was, I think, 2.7, 2.8 a year ago, and it's still in that range. It's actually ticked up a little bit to around 3 a few months ago. And we know affordability, price levels has been something that's people were extremely unhappy about before the last election. They're still unhappy about it. So I'm wondering if somebody in the White House is telling President Trump that Jerome Powell might be doing you a favor by not cutting too fast, because if inflation starts going back up and the affordability situation gets even worse, President Trump's approval rating would be even lower. I'm looking at the same data as everybody else. Inflation is less than 3%, which is good. Historically, 3% was the target rate. Now it's been lowered to 2%. But the job market has been soft for the last few months. But I think today, in the Fed's press conference, they mentioned that they see the job market firming up. So where they are is inflation is a little higher than what they want. They're seeing, I haven't seen this yet, but they're saying that the job market might be improving from the soft patch that it's gone through. So they're holding it steady. Powell only has a few more months left on the job. And what you have to hope for is whomever comes in acts on the data and doesn't start cutting if inflation is too high. But I think price levels being high, whether inflation is 2% or 3%, the fact that price levels are high, unless you go through a deflationary cycle, incomes are going to need to catch up to the current price levels for people to be happier. And that's not happening immediately.
Great, thank you. Interesting. So now we're going to move on to another section, which is just talking about changes in the environment for valuation, fundraising, consolidation, M&A, IPOs, that sort of thing. And so, we have record high stock market indices driven by AI companies, by the hyperscalers who have giant market caps, who are a big part of the NASDAQ, for example. But we also have a contrary indicator, which is the SaaS Capital Index, which is public SaaS companies. Its valuation levels have been ticking downward for years and are now at about 5.5x of LTM revenue. And so as of December, and this is in a sector where SaaS companies were getting valuations of 10 times revenue or more. Fast growing young SaaS companies were getting much higher valuations just a few years ago. And the IPO window is open, but there have been very few digital health IPOs. There have been about 3 in a year, it seems like, and that's like Heartflow is one, and
Hinge Health,
Hinge,
and Caris Life Sciences is kind of AI-ish. I don't put Omada in the AI category, but not too many, right?
Very few, and then there's many digital health companies rumored to want to IPO. So we've heard rumors about Maven, Alliday, Datavant, Transcarent, Virta, and others, but we haven't seen them file S. So. And so that's a mystery. There have been many IPOs, but not a lot of digital health IPOs. And the implication is that digital health companies, they don't look great. They if they're going to IPO, they ought to have great margins, great top line growth rate, and great customers, great prospects for future growth. And if they're not able to IPO in today's environment, then there must be an issue with them on that kind of front. So, Ron, any thoughts on the environment for valuation, fundraising, consolidation, M&A, IPOs?
Yeah, let me mention a couple of things. One is the fact that you brought up the skepticism from public market investors around digital health. And we know the first generation of digital health companies that went public did not do well. The digital health public market index from Rock Health and so forth, it was always a laggard, sometimes by a significant amount, with the cloud index or the NASDAQ index and so forth. However, if you read some of the latest pieces, for example, from Bessemer Venture Partners. They have a recent article about the fact that the first generation of digital health companies were growth at any cost,
Mm-hmm.
which are not something that the public markets like as much as the private markets. So their free cash flow margins were terrible. Uh, their top line growth was good, but it wasn't astronomical like some of these other technology companies. So that combination never kept public market investors that interested. But what they argue is digital health 2.0 companies like Hinge Health that have good free cash flow margins, not great top line growth, but good top line growth. So if you add their free cash flow margins to their top line CAGR, the rule is that you want it to be over 40. I think Hinge Health is like 95. This is sort of the second generation digital health companies that are going public that have better margins, better growth. Therefore, you can expect them to do better in public markets than previously. And the markets generally have given up on the growth at any cost mentality. Now, before you go public, you need to make sure your P&L is in good shape, which is probably why we're not seeing a lot of IPOs, because companies are now making sure they're public market ready. But also, there is a lot more capital available for late stage private companies than there used to be. As a matter of fact, if you look at what's happening in the private markets, you have a concentration of capital in late stage companies that are much more de-risked than mid stage or early stage companies. And then there's a concentration of capital in early stage companies that are sort of ex employees of OpenAI and so forth that have started new companies, and they get uber bucks right out of the gate. But there is less money available for the average startup. So even though the top line number of total amount invested is up, the number of deals is way down. So there's concentration of capital, and the middle is getting hollowed out. It's because Series A, Series B companies are still risky. They haven't met some of the milestones that the investors are looking for. They're having a hard time raising money. And that can explain why if you're if you fall into the high flying category, the world's your oyster. Open Evidence, I think the metrics that I just saw yesterday, their valuation is $179 million per employee. They have 69 employees, and they have their last valuation is $12 billion. But then, if you're not in those categories, then you have to put up with, the insulting X revenue valuation.
Yeah, very interesting. So people are calling this the barbell economy, which is that there's certain favored sectors. GLP-1s is one of them. Gen AI is another one of them, and that's getting a lot of the attention in deals. And then there's everybody else who is getting less attention and less deals. And I have heard predictions in Silicon Valley. This is not digital health, but this is in Silicon Valley, where they look at, okay, a company has 70 employees, but of those 70 employees, maybe 20 are engineers. And then what they'll do is they'll look at the recent private market valuation divided by number of engineers, and slowly that number is creeping up toward 1 billion per engineer. There's a contest to see who actually gets to $1 billion per engineer of company valuation. Pretty astonishing stuff. So in our chat, by the way, there's been a bit of a pessimistic discussion with Roland and Felicia predicting that this is going to be a year of layoffs and staffing cuts in healthcare. And so I actually heard a hospital CIO make this prediction as well, just saying that strictly for hospitals and academic medical centers, he expects them to have squeezed margins this year, and they're going to respond by cutting clinical staff in the face of that, which is a tough thing to do. And then there'll be some room to make it up, but not fully, with AI automation for the people who are left there. But he predicted job cuts. And so we have, Roland talking about 2026, the current year, being a big year for job cuts across all industries. And Felicia talking about how providers are going to try to replace physicians, pharmacists, and nurses with AI. And so there's been talk of that in 2025. I don't think there's been much of actually doing that in 2025, but certainly in 2026, we may see people acting on this more. Anthropic Claude Health can deal with healthcare administrative matters as an agent. Then you may see as a healthcare coder, for example, billing employee, you may see cuts in headcount in those areas. So thank you, Roland and Felicia.
I would quickly add to what you said is I write a column for Fast Company, the magazine. I put a link to it into chat. I don't see the chat you see, but I clicked on chat. My most recent article that came out in early January, I write about the fact that U.S. health economy is headed into 2026 with a cloud over it because of the Medicaid cuts, potential rollback of TB, which is a source of high margin revenue for companies, for health systems and specialty pharma, and the expiration of the enhanced ACA subsidies, which means less insured people. This is threatening to the business model of providers, which is why they're going to be probably laying off staff because they have to get ready for a lower revenue environment. And one of the things that some of them are doing are investing in technology that can make their staff more productive, that can help them get by with less people to deal with the tsunami that's coming. But with over $1 trillion over a decade cut from Medicaid, there is prior authorization now for some Medicare procedures and this other stuff, site neutrality of some procedures that had to be in a hospital now are allowed to be done in ambulatory surgical centers. So this all presents a threat to the revenues of health systems. Laying off staff may not be related to the fact that they think they don't need them because of AI. It's for the most part related to the fact that they're seeing a turbulent business environment ahead. And of course, if AI could step in and make up for the staff that they're laying off, then you have a double whammy.
Yeah, so there's been a lot of hype about AI causing job layoffs, but as you're saying in healthcare, it could be fundamental drivers being weak causing layoffs, and then hospitals with little budget for tech trying to figure out what they could do to cover the gap in labor that they have. Roland asks, why are investors investing at such a late stage? Is VC getting in late on what they missed earlier? Are they more risk averse? So, Roland, my view of that is that yes, a lot of VCs, so in theory, VCs ought to be risk takers who jump in aggressively to take risks in good times and in bad times. In practice, a lot of VCs have not found investment themes they like over the last few years and have been avoiding early stage because it's so risky, but they will put money in later stage because they have to put the money to work in a given time frame, and the later stage gives them the comfort of having figured out product market fit, having revenue, possibly having earnings. And so it's been risk aversion in the current kind of time frame. Daniel asks, can you comment on the valuation of open evidence? Looking at what they offer, it feels like this will become a commodity soon. Well, Daniel, I think that's a risk. I think what's special about them is that they have the rights to the highest quality medical information. So they're Gen AI, but they figured out the rights, I think it's to JAMA and New England Journal of Medicine. And they also know how to provide citations with great exactness, which Gen AI is usually poor at doing, but they can give new, better, and summary information to clinicians at the point of decision making and provide the citation that backs it up. So, Ron, any thoughts on VCs not engaging in early stage, but yes, engaging in later stage, and also, which was Roland's question and Daniel's question of what's so special about open evidence. And Ron, it looks like your microphone's off.
Oh, yeah, I think inadvertent. I think it's important to spend a couple of minutes on what's going on in VC, why they're concentrating their capital in late stage and such. So for the last few years, the exit environment has been slow. Steve, you mentioned there haven't been that many IPOs. IPOs usually return more capital to the investors than M&A. And if you look at the M&A market, like I think a couple of quarters ago, The third largest acquisition was $12 million. So even if you look at, okay, there's about 50 M&As in the last quarter, they're not necessarily for big dollars. None of this returns a lot of capital back to the VC investors, and by extension, their limited partners who gave them the money to invest. So what happens is the VC investors have the guillotine at their neck because they can't raise new funds because they haven't returned a lot of capital to their LPs. So one way to mitigate that is to pile on to these later stage companies that are closer to an exit. Yes, they're not going to get 100x IRR or return on invested capital. However, what they are going to get is some capital back that they can return to their LPs. So that's one reason that there is a pile on to these safer later stage investments. And I mentioned on early stage because we're in a earlier stage, because we're in a risk-off environment. They don't want our topic of the day, repeat of the Zombicorns from 2020, 2021. They're going with people they know who have been with their previous companies and so forth. They're choosing to write bigger checks to those companies rather than distributing their capital. The other thing that's very important for us to mention is that because of the low distribution, LPs who are continuing to put money into VC are increasingly giving it to the bigger name VCs, established VCs. So I think in 2025, more than 80% of the new capital that got invested in VC went to established VCs rather than emerging managers. So these big VC firms now have multi-stage investment strategies. They can write checks at seed stage to growth stage. That means they can write larger checks in early stage. They can follow that money with Series A, Series B. And that makes it tough for smaller firms to compete. Now you have Andreessen Horowitz at seed stage, and they're more indifferent to what size check they write and the valuation than a smaller firm that needs to show good IRR and is much more sensitive to the valuation. This is changing the dynamics. That's the environment in right now. And on open evidence, I wrote an article in 2021 when Babylon was in public markets for $4 billion. I said, I don't understand their business model, why they're valued so much. Their CEO called me and started arguing with me. I told him, listen, dude, you have a $4 billion company on NASDAQ. What the hell do you care what I write? I'm writing from my own experience of running my own company that these chatbots as a form of triage is a tough business model. So I don't understand sort of the valuations the market are giving you. I'm probably wrong. Enjoy, running your great company. And then 6 months later, they declared bankruptcy. So open evidence, I used to be a practicing physician. I wasn't looking up studies that often. Usually the stuff you're doing, if you're an oncologist, cardiologist, occasionally you need to look something up. So I'm not sure why they're getting this much love from private markets, but also UpToDate, which has a huge installed base. They rolled out their Gen AI tool, and whether open evidence with New England Journal and JAMA is worth that much more, I'm not sure. But we've seen big valuations before. Even Hinge Health went public for $2.7 billion. Their last private market valuation was over $6 billion. So it was less than 50% of their last private market. So let's not put too much into a valuation that these private investors are assigning to the company. It may not be real.
Yeah, thank you. And a very lively chat with Donna and Felicia and Roland about what's going on with VCs. I'll just add, Roland, to what you said, that starting around 2008 to 9, digital health gained what I call a double halo. So the Fed cut rates to near zero at that time. And so investors all around the world wanted to get into US equities, into growth equities. And digital health was the ultimate growth category because it was both healthcare and tech. And there's only two growth categories on earth, healthcare and tech, and digital health is both. And so digital health had this dual halo from 2009 through around 2021 to 2. And then the Fed raised rates and investors started moving away from growth and toward income. And since then, what I've been hearing from investors is that digital health is actually, it's a troubled sector because there haven't been enough good exits from from those generations and those cohorts of companies. And so digital health now I think has a negative halo, except for AI and healthcare. That has a new positive halo and bubble around it right now. So that's the companies. But then with the funds, I think there was a study that came out that said in the large B2B sector, half of venture funds that invested heavily in the 2020, 2021, 2022 timeframe will not be able to raise next funds, was the study. Now, digital health will probably follow that, I think. But they weren't talking about digital health, but digital health, I think, will follow that. That means we're going to see a lot of funds that have mostly invested their funds and can't raise next funds because they can't have exits and can't show a track record. And then Andreessen Horowitz has made a big prediction about the future, that in the future, they predict all mid-sized venture funds will not be able to raise next funds. There will only be giant venture funds like themselves and small niche funds, and that the biggest value add that the giant funds can bring is get this political clout, which is not in the past. Software companies were tool companies that got to avoid politics. It was rare when the government got in and tried to do antitrust around browsers or something. But they think that political influence is going to be a big deal on the part of venture funds to use it on behalf of their portfolio companies. So interesting predictions from them. So we're going to skip a little bit on sections on our side just for timing reasons. So Ron, any reports that have come out in the last month or so that you want to tell our audience about?
Yeah, I mean, I mentioned the study that just the paper that I just read from Bessemer Venture Partners that talks about these dynamics on health AI, what's driving adoption. The companies that are going to win are companies that have deep integration, proprietary data, and so forth. There's 2026 healthcare outlook from PitchBook, which I found really good. It looks at biopharma, medical devices, and health techs. Health tech, there's a report, Trends Shaping the Health Economy from Trillion Health, which was excellent. And then What to Expect in the Healthcare in 2025 and Beyond, which is from McKinsey. Those are three reports that I've read over the holidays, which I thought were
very interesting. So good. So then just one of the sort of a crowd pleaser part of our show, is there any use of technology, whether it's a product or a use of AI on your phone or something that you like to use that has improved your life recently? And so I'll call out two. One is that there's a new generation of, get this, chargers, and this is chargers for your wall or for your car, that are just faster than prior chargers. People may not be so aware of this, but our devices tend to be bigger. And so they're USB chargers that could charge your laptop or your iPad or your phone or your headset or whatever. And so you can plug it into your wall and charge all of them at the same time fast. And it's intelligent charging. It feeds your device as much power as it can take without damaging its batteries. And you can have them for your car as well, in your cigarette plug in your car. So I recommend people look into that. And then that's the first. The second is, I'm just often delighted by the kinds of sophisticated answers that I get from ChatGPT voice mode or Gemini voice mode. This is the native voice mode. And my daughter is reading the Iliad right now. And so I asked a question, which was, why do mothers still name their sons Hector but not Achilles? And I got a very smart answer from I think it was ChatGPT voice mode. And it was because Hector fought for his family and Achilles fought for glory. And I thought that was very smart. How does this AI, large language model, know this? And then I asked it the same question later, and it gave a terrible answer. And then I asked a different AI later, and it gave a different terrible answer. So it can be variable, but the AI voice mode is just, it keeps getting more natural. It keeps having better answers. So Ron, any technologies that have improved your life?
Have improved my life. They've made me busier. There was a time when I used to start my first case as a cardiologist at 7 a.m. And then when I was done seeing my last patient, I went home and did whatever I wanted. Nowadays, if you're an information worker, you're on 24/7. And these tools that come out, mobility smartphones, apps, 100% connectedness and stuff means you never unplug. But, I use Gemini like anybody else to look up answers to questions and stuff. I find it helpful. I find that I'm getting to resolution on technical stuff at least much faster when I look it up. Ask Gemini, but I'm not sure about much else that I might recommend. I'm not a practicing physician. I haven't been for a long time. So in terms of health AI tools, it's what I hear about at conferences and my research that I write in the AI Doctor blog on Substack or for one of my articles.
Yeah, thank you. I like the Gemini suite a lot myself, and I find that if I want a fast answer, I go to Google Search AI mode, and that gives a fast AI answer and Google search results at the same time. But then if I want a more thoughtful answer, I go to Gemini and I go into the thinking mode in Gemini, which is slower. You're definitely waiting for 10 plus seconds for an answer on the thinking mode of Gemini. But then also, if you're using it in Google Slides, there's Gemini in Google Slides, you can convert an outline into a beautiful, more graphical PowerPoint presentation, slide presentation. And if you're using Gemini inside of Google Spreadsheets, you can go from just numbers to a better formatted, fully laid out spreadsheet. I think Google's done a great job of embedding Gemini in the different applications. In Gmail, Gemini can give you a suggested 5-sentence reply to a message that's usually pretty spot on. So Google Gemini, I've committed to the whole suite as opposed to best of breed. I'm not doing best of breed. I'm not doing Grok for news and Anthropic Claude for finance or something like that. I'm just learning the full Google suite. So
I mean, Grok for news would be an interesting choice.
Well, specifically because I trust that they would give me news of the last 1 hour from Twitter. Whereas if I did Gemini for that, I just have no idea if is their news going to be, because usually you think of LLMs as not having the latest news. So
Okay.
with Anthropic Claude, if you want news, is it going to give you news of the last day? I don't know. But with Grok, I think they'll have news of the last day and the last hour from Twitter. But I'm not sure about that. So then any news about upcoming conferences. Vive is coming up. Vive is a great innovation conference. It's done in association with Chime, which is a health information executives. That's an innovation conference and investor conference coming up February 22nd in LA. And for young companies that sell to payers and providers, that's a good conference to go to meet VCs who are attending the conference or VCs who are in LA, San Diego. And then HIMSS coming up March 9th through 12th in Las Vegas. HIMSS focuses on hospital CIOs and CFOs. And so for startups that are selling into those budgets, this is a good conference to go to for the expo floor and to meet customers, and also for investors who invest there as well. This is a trade show, whereas the Vive is an innovation conference, but HIMSS is a trade show. So those are useful conferences from a HIMSS from a trade show perspective and both from an investor perspective. Ron, any conferences you're going to or that you're excited about that are coming up that you want to tell our audience about?
Well, I am going to Vive, and you mentioned that it is a good conference for payer providers. And there are a couple of conferences coming up that I'm speaking at. One is the Everything AI Summit on March 23rd in Miami. And that's not just healthcare, but they're putting a premium focus on healthcare as a big part of the day. And then there's the Medical Dental Global AI Summit coming up in London, June 26th through 28th. And I'm speaking in that conference also. But that is in partnership with AI Med, which is the conference that I referred to, that I did a book signing and attended in November and spoke. I think I did a keynote and a couple of panels at AI Med. And this is going to be in partnership with AI Med Europe, I guess, which is a new entity. But it would be the Medical Dental Global Summit is in partnership with AI Med. They're each going to have their conferences there, and we're going to be attending both, I guess. But London in June, not a bad location, and the speakers, which we're involved in recruiting, are very accomplished and substantive speakers.
Great, thank you. And from our audience, Felicia is asking advice for Zombicorns raising money. We'll be getting to that very soon. And Donna comments that she likes Grok for specific research tasks. That's great. Thank you, Donna. So personal notices. So my personal notice for this show is that our next show will be Wednesday, March 11th at 4 with David Shaywitz, who's a lecturer at Harvard Medical School. And the topic is getting from Gen AI to patient agency and better patient outcomes. And you can find all of my upcoming events, including cocktail receptions in Boston at stephenwardell.eventbrite.com. Ron, you're on cable news all the time. Do you have any upcoming personal notices?
Well, I have a couple. First of all, I go back to my book, which is the only business book written about the business of AI in healthcare. It's called AI Doctor, The Rise of Artificial Intelligence in Healthcare. Steve, I don't know if you can put these links where people could see them. The chat box that I'm looking at, there's nothing in it other than a couple of links that I put on there. But a couple of things. I write the AI Doctor blog on Substack, and I look at adoption issues, macroeconomic issues, investment issues, and so forth. If you can put that link on chat, if people want to subscribe to the AI Doctor blog. I've actually been writing that since September of 2021. So, and it just got moved into Substack 1st of January. So I haven't done much to promote it yet, but let this be the first promotion of the Substack, the AI Doctor blog.
So I in our LinkedIn chat, I did add aidoctorblog.substack.com in there.
Okay. And then I mentioned I write a column for Fast Company, and I sent you that link also, Steve, if you want to put that in there. My last article was The Future of the U.S. Health Economy. And that came out early January. The next article that I've got coming up in February is about whether we're in an AI bubble. But most recently in 2025, I wrote about these high growth companies that are reaching milestones, AI native companies that are reaching milestones that use 6 to 7 years. Now companies are achieving it in a couple of years with much lower headcount. Talking about the potential impact of AI on jobs. And also, we've had a lot of macroeconomic upheaval in the last year with the tariffs, cuts to R&D. And I wrote some articles tackling what are the implications of these types of policies for the innovation economy and for the global economy in general. So those are some of the things I do on an ongoing basis that might be of interest to this audience. And I've got appearances coming up on Fox Business and Bloomberg to talk about some of these topics.
Thank you. So now we're moving on to the second half of our show and our main topic, which is Zombicorns. What's next for funded companies with growth issues? So we actually got some questions leading up to this, like, great term Zombicorn, what does it mean? And I think the simple answer is it was a unicorn, which is a company with a private market valuation over $1 billion, a digital health unicorn that became an apparent zombie. And so, but Ron, you tell us, what is a...
First of all, let me make sure that I give the great Steve Wardell credit for coming up with that term. You mentioned it to me for the first time, but I'm so shameless to take it and run with it. But I've always given you credit for it. And, you know, the fact is, when interest rates are zero and the federal government is pumping tons of money into the economy, people have more money to invest. And anything with telehealth or home diagnostics got funded, and investors were bidding up these companies, the valuation. So you had a lot of companies getting funded, some of them with terrible business plans, and then at very high valuations. So what happens is when the frothiness comes off and you go back to a more normal environment and people are not as euphoric, you go back to raise more money again in 18 months or 2 years. People are looking at this company and they're saying, oh, you only have $2 million in revenue. 2 years ago, you raised at an $80 million valuation. What was your revenue then? and it wasn't even $1 million, but they got a massive valuations. And it turns out now investors aren't even interested in investing a $20 million valuation. And a lot of these companies that raised a lot of money and could withstand not raising more money for a longer period of time, they got married to those valuations. They said, okay, we're going to grow into that valuation, and because we want to avoid down rounds. Some of them laid off some of their staff, they lowered costs. But healthcare, traditionally, it's been hard to grow really fast like the other sectors. So eventually, you either have to raise money at a lower valuation, or you're not even going to be able to raise money, or you need to temper expectations, let go of a lot of your people and be a smaller company at a lower burn rate and try to get to profitability. Or close. And when you get stuck in that situation where you're not really investable and you're trying to find your way in the world on like, what do you do with this very high valuations and nothing else to show for it, then you become a Zombicorn. The corn being from unicorn, maybe you weren't valued at $1 billion, you were valued at 100 million, but that was X what you should have been valued at. And zombie is the fact that now you're walking around like a zombie and trying to find a way out of your current dilemma. So I think it's a good term. And this overhang of these bad investments, which have been sitting on the NAV, net asset value of VC firms, paper gains without, any path to a meaningful exit. It's part of the reason VC as an asset class has fallen out of favor with LPs. And if they are putting more money in, they're putting money into safer, more established firms. And there are people who think it will take another 4 or 5 years for the impact of this to wash off of the VC. And I think, Steve, you mentioned that there may not be a reset. This may be the new normal in VC, at least Andreessen thinks.
Yeah, interesting. Thank you. And let me give a narrow example of a Zombicorn as well. So the narrow example would be that you have a young company that's growing fast and losing a lot of money, and somehow it manages to raise a round at a $1.1 billion valuations. Congratulations, good for them. And then they run into 2022, the Fed rapidly raising interest rates faster than ever before, and the risk-free rate goes from 0% to 5% in a short period of time. Suddenly, VCs are in turmoil. Their ability to raise money in the future is called into question, and public market valuations of growth companies go down, and they get counseling and advice that says, be default alive, not default dead. Figure out how to take your cash pile that you just raised and stretch it out into the future, and don't spend so much on growth. So they cut back on their spending on growth, and their top line growth rate goes from maybe 60% down to 15% or something. So they're not a growth company anymore and they fired some sales reps, et cetera. And that cut their burn, but they're still earnings negative. And so then the next thing that happens to them is that they mark to market their valuation as compared to HIMSS or Teladoc. And they come out with a public market value with an effective valuation of $400 million instead of $1.1 billion. But they have a $700 million preference stack in the company. And so that means that management's stock options, management's equity is underwater by hundreds of millions of dollars. And so management goes and does a thought exercise and thinks through what steps are going to have to happen in what order and what time frame for our equity to be worth anything at all. And the answer is it probably will never be worth anything at all. So why did they go on this 7-year journey to get to the point where they are right now if their equity is not going to be worth anything? So then management goes to the board and says, hey, we have an idea for you. How about you top us up on equity? And the board says, well, we're all in the same boat here, and we all agreed to this in the past, and we're all having a tough time right now. So our idea is actually no. How about we not top you up on your equity? And so then, and we're at cross purposes here, because these VCs who have invested, this is coming directly out of their possible return. For them to give management a greater return comes out of their possible return. So then you start seeing, so now you've got a company that's not a growth company anymore, that can't raise money in the current environment, that is still earnings negative and is running out of cash, that is not going to get topped up. Management has put 7 of the best years of their careers into this company, and they're not going to get an equity return from the company. And then the next thing that happens is that their entrepreneurial CTO leaves suddenly to go join another company. And meanwhile, the greatest technological revolution of our lifetimes, which is the Gen AI revolution, has kicked off. And so the company makes an assessment: can we freshen our tech stack and can we just be Gen AI? Can we just spend some money on tech and just be Gen AI? And the answer is no, they can't. And then suddenly Andreessen Horowitz announces it's putting down a $30 million Series A on a Gen AI company, rebuilding the exact same products as the unicorn and targeting the exact same customers as the unicorn. And now recruiters are calling all of the executives of the unicorn and asking them if they would like to this year be the head of sales of the company, or next year they could be the regional Northeastern director of sales for the company. And then unicorn is now somehow looking to freshen its tech stack, become a growth company without spending too much on growth, and then raise money and then sell itself somehow is the agenda that the board gives to the CEO. So that's an example of a Zombicorn. So Ron, are you seeing, unfortunately, by the way, these are some of the most prominent companies in digital health. They're some of the best. 3 years ago, they were viewed as the best place to be in digital health because they were bound for an IPO. You could be part of an IPO, you were part of innovation, you were part of changing healthcare, improving care for patients. And now a number of them are stuck, and that what they need to do, they're not going to be able to do that in this market. And interestingly, there's another aspect of digital health, which is that people in healthcare are stickers. They stick doing things. And so in other industries, people would have left the company and done something else, left the industry, gone to a different industry. People in healthcare tend to stick at their company and in healthcare, in part because they had a mission. They're in diabetes care because their sister died of type 1 diabetes when she was 9 years old, that sort of thing. And so people tend to have a mission and they stick. And that then means that the play out of this is the most painful possible play out of how this plays out over time, because people who could have exited are all sticking around, and then no one knows who the winners are because there's so many companies that are sticking around instead of having some exit, leaving others to be in a good position. So for our audience, feel free to ask questions about the Zombicorn situation. But Ron, any thoughts? So for these companies, the theme of today's show is what's next for these companies. So can you give us what are you seeing and what's next for them?
Well, first of all, I'm very depressed after that very vivid description of how it plays out. It was painful to listen to it. And the fact of the matter is you're 100% correct. One of the things that amplified sort of the zero interest rate period, the ZIRP era, and the aftermath that the entire venture industry is dealing with, including digital health, is the fact that a lot of times when you have euphoria, people are writing checks. They're writing checks to ideas that sound good, seem like they can generate returns on capital, but also they have a societal impact. And anything in healthcare sounds really, really good. You mentioned any application of technology in healthcare. It's hard to come up with one where somebody listens to it and it's like, this is terrible. I don't like this. So what happens is everybody wanted to increase their allocation to healthcare, given that there was pandemic and stuff. So we felt the impact of this Zombicorn era more so than other sectors of the economy. It's my guess. I don't know about every other sector, but I know we felt it. And the reality of the situation is, and I said this recently on a panel, when I started my company, I had already been a cardiologist. I had already built technology for healthcare while I was doing my cardiology training. I'd already been a McKinsey consultant working in healthcare, consulting for big healthcare companies and so forth. When I started my company, after a couple of years, I realized I knew nothing about healthcare. Once you're on the vendor side and you're selling into healthcare, it's a whole different ballgame. So this is a very complicated sector. It's an insider's game. You really need to know the flow of patients, dollars, clinical workflows, administrative workflows to be able to disrupt it. You have to have insider knowledge. Many of the people who start companies in healthcare are high-flying technology, successful technology people who know how to build technology, because usually clinicians and people who work inside healthcare are too conservative. They don't have the entrepreneurial background. They don't know how to build technology. And if there is one lesson we've learned, the healthcare sector, providers, payers, life science companies, they're an immobile object. They're an immovable object. No matter how fast you're going, if you're not planning for this maze of how you sell into healthcare and how you drive adoption, they don't really care what your resume is and how much money you spent on your product and who your investors are. You have to solve a problem for them. You need to have positive ROI. Even then, if you don't know some people in healthcare that are willing to buy from you, no matter how great your product is, it's not easy to sell to these healthcare customers. So that makes pivoting hard, and deciding that this product's not getting traction or I need to pull more salespeople on it, not a viable solution. So if you're stuck in a situation where you're not seeing your growth, the growth you expected, the growth upon which you raised money, you have to go back to the basics. You need to figure out what's keeping you from getting adoption. You need to be realistic if this product will get adoption, because there are a lot of other products out there that might be a priority. They may be solving a more mission critical unmet need for the customers. And if you don't have the money or the resources to do that, you need to think about strategic options such as being acqui-hired. Your technology might be helpful to somebody else that has money and is getting some traction. This would be a nice tuck-in for them to add it to their portfolio. Usually digital health companies get acquired by other digital health companies, but some of these hyperscalers that are coming into healthcare and they have tons of money and stuff, they might be interested in a niche technology that they could add to their platform as an add-on. So you need to pound the pavement to find a buyer for your technology or your team and return some capital to your investors. Declare victory and live to fight another day.
That's great. That's really interesting. And for our audience, feel free to throw questions in the chat. And by the way, Ron, so Shobi in the chat has asked, are you currently evaluating early stage digital health investments yourself? So not today's topic, but I wanted to get that question in there.
Yeah, I mean, I'm always looking at business plans and investing, advising, and so forth. Having been an entrepreneur in this space and having seen all the barriers that I did not even know existed until I ran my company for 7 years. I look for things that a typical investor who hasn't necessarily been an operator in this space doesn't look for, sort of those subtle barriers around workflow, or whether it's a priority. It might be a good technology for a good use case. Fortunately, with limited budgets, limited bandwidth, limited ability to drive change management, your technology may not get adoption just because it's lower in their priority list. So we'll look at it and we'll provide feedback. Sometimes it's good, sometimes in early stage before you invest 7 years in it, it's good to get realistic feedback and pivot, or go build a pineapple factory or something instead.
So I'll go through just some ideas and options here. So, one of the problems that Zombicorns are facing is that VC's attention has been drawn to new Gen AI companies. And what's so special about new Gen AI companies is that there's a claim that, well, so first of all, new Gen AI companies, they have a promise of an intriguing product, but they usually don't have distribution. They usually don't have a good product understanding of the customer's needs. They usually don't have good marketing. They usually don't have good sales. They're promising to build that later. And so if you are a zombicorn, or I'm sorry, if you're a unicorn and you're looking for what to do next, you presumably have that product management understanding of the buyer's pain. You presumably have the sales and the marketing. And so you're looking to backfill a Gen AI product. And what's so special about Gen AI products? Well, in theory, you build them faster, better, cheaper, and they have new feature functionality that the old tech stack doesn't have. And so in theory, you ought to be able to use your current team, current dollars, maybe new team, new people to build that feature functionality. That's a step you can do. In doing that, you will attract the attention of investors, and you already have the product management, marketing, and sales that helps you sell to the customer. The problem with that is that that's actually very hard, and VCs won't believe you necessarily. They won't. If you say, look, we have a Gen AI product as well, they're not going to believe you, and they're going to think that that brand new Gen AI company that just raised a $30 million Series A, they're going to think that it is unencumbered by history and that it has a clean cap table or something. And so that's the battle you'll be fighting. But one possible alternative is to reinvent your product while keeping your product management, sales, and marketing in place in order to be able to compete, to boost your growth rate and compete with the new competitors who have entered. So any thoughts on that, Ron?
Yeah, I mean, I would, I've been accused of being a pessimist sometimes. I would strike a more optimistic note for this one time than you, Steve, in that no matter how much money the new kid on the block has raised, $30 million or whatever, and they're coming out of the gate with Gen AI, if you understand your customer, if you have an installed base where you can add a feature and improve their experience, you can outthink the other company. Understanding healthcare workflows, understanding pain points, understand your buyers' business models are great competitive advantages. So if your product is getting a little clunky, if your tech stack wasn't built for Gen AI, however, you're solving a real problem, you have an installed base, you have some relationships, being able to use whatever resources you have and availability of these open source models to improve your product, improve its penetration, and improve its value proposition, you can beat the company that has $30 million to the punch because they may be getting a lot of money because they used to work in OpenAI or Google or what have you. And there is no guarantee that they're going to be able to build a good product as good as yours or gain acceptance or adoption in healthcare, a sector that they may not necessarily be coming out of. So I would say good, deep thinking, speaking with your customers, understanding the workflows better, understanding the tech stack better. You can reposition and compete. Don't let how much money somebody has raised intimidate you. And having a foothold is always a good place to be. However, you do have to overcome all the negative issues that Steve just mentioned in terms of the, cap table that's not as clean, an image that's been created in the old world technology, and now you're pretending to be a new world technology and so forth. All of that is true, but it's to me, it's not a fatal blow.
That's great. Thank you. So another angle, another strategic alternative for the unicorn or for the company that's trying to not be a zombicorn is to look into trade sales. So many commentators have said that certain parts of digital health are ripe or overripe for consolidation and trade sales. That's good. And yet we don't see a high level of activity. So they've been ripe or overripe. And there have been a lot of reasons for this. But the fundamental issue is that there's been over entry into many categories and subcategories for a long period of time. This was then sustained by further fundraising. And then there has to be consolidation and shakeout. At the same time, the buyer, who might be the hospital CIO or the employer benefit leader, their tastes have matured. Their buying preferences have matured. They're no longer wowed by a single product. They'd like to see an integrated suite of products. They know what they want them to do. They know what they want to pay for them. So the market's matured. And that means that leaders in the market are in a position now to buy what they're missing. They're in a position to go. So this could be incumbents like HCA or Optum, or it could be super vendors like Teladoc buying Livongo or I think we saw just recently Sword Health buying Kaya Health or others filling out gaps in their product offerings. And I definitely, as a unicorn, I would position myself for that. So just some comments on that. So that means getting out there and talking to healthcare incumbents or to super vendors who might acquire you, and working with them if they have orchard programs to be a tree in their orchard, that sort of thing. So in this, I would say that for trade sales, first of all, we've seen under consolidation, and with a lot of predictions that we're going to see a growing amount of consolidation and shakeout in coming years. I think we will see a pickup. That's good news. I think it'll be mostly advantaging the consolidators, not the targets. I think the consolidators are going to make low bids. They're going to enter subsectors that have multiple companies in them. They're going to make a couple low bids, but we're not going to see what young companies want, which is irrationally high bids. That would be very nice if we saw irrational actors coming in like OpenAI and making a bunch of irrationally high bids. I think it's going to be super vendors coming in, making to a subsector that has 8 companies in it and making a low bid to 2 of those companies, and one of them accepts it, and then they buy that company. And from that point on, there's now fewer possible buyers for the remaining 7 companies in that subsector. So, and then what you really want to be is you want to be the consolidator. So if product buyers like hospital CIOs or employer and benefit leaders, if they want to buy integrated platforms and suites, then you want to be in the best position to be in is to be the consolidator who's putting together the suite and selling it direct to the purchaser, of the product purchaser. And so, and that's only available to companies that are in leadership positions, companies that have great brands, companies that have great products, companies that are market leaders, companies that already have pieces of the suite puzzle, and companies that have great financial backers to them. They're in a position to say, hey, I'm going to be the consolidator. I'm going to have the suite. I'm going to have the integrated platform. I will buy some of these point solution vendors. That's the position that you want to be in, not to be the point solution vendor who gets 1 or 2 lowball offers and has to pick one of them or gets passed over. So that's so if you want to sell the company, you should evaluate whether you could be the consolidator, the vendor who puts the suite together and acquires the other vendors into your suite. That's the position to try to be in. And when I look at digital health, so provider tech selling into provider organizations, that is one where the buyers want suite, where the buyers have matured, they want suites, they want integrated platforms. Selling to employer health tech, that's like Teladoc selling into employer health tech. Same deal, they want that as well. Payer tech, that's like that's software and tech companies that sell into payer budgets. I've not seen the same trend toward buyer maturity wanting suites. Pharma tech, we're actually in a period of entry in pharma tech, new entry, not a period of consolidation in pharma tech, I think. And consumer digital health, I don't see consolidation in consumer digital health happening. So those are some of the sectors it's happening in, some of the ones it's not happening in, where buyers are maturing and want suites and on a buyer basis are driving consolidation. So any thoughts on being acquired, being consolidated, being the consolidator?
First of all, I would say in a crowded market where there are a lot of companies running around saying the same things, and the fact that actually I think there are over 61,000 VC-backed companies out there right now. That number was 10,000 in 2010. So a lot more companies have been funded, are looking for exits, and you're joining a large inventory. So you have to do something to stand out from the crowd to achieve an exit. And I'm saying that not to discourage people, but I'm also saying it to emphasize, if you get an offer, don't be insulted immediately, because it might provide a path for you to have an exit, have a win, return some capital to your investors, and go start the next company. We're bringing in all the lessons from that. My sense is that a lot of the stuff that we're talking about is because we don't know what the hell we're talking about. There are people like Gary Marcus that are saying these LLMs are poison and they're not going to work out long term. He's advocating for world models, and that in clinical medicine, the hallucinations are going to be a hard stop. Actually, Microsoft published a study where their LLM did 95% on USMLE licensing exams, but then they made it more lifelike, where all the evidence is not captured nicely in a clinical vignette that you can read and respond in a multiple choice question. And once they started making it more lifelike, like physician getting one piece of information at a time, not having all the results of the tests and labs and images there at the same time, the accuracy dropped to less than 20%. So why am I saying all of this in the context of what you just said is I think we're at the start of this first inning. There's plenty of room for innovation and figuring out how to use these models to solve real problems. I think it was the Bessemer paper that said less than 5% of things that could be problems that could be solved with LLMs in healthcare or with AI have been addressed. So being creative, thinking about whether your technology stack could be used in an adjacent area to increase the value, but also a mistake that I always made when I was running my company, I was really focused on product and did not spend enough time getting the word out about the company, the products, socializing with investors and potential acquirers and so forth. I'd say you need to get out there and socialize and help people get to know you, what you have, and they may come up with a solution for your situation. You may form a partnership with somebody that ends up acquiring you. Right now, it's time to be more outward facing in this tough environment and focusing solely on the product.
Great, thank you. And then for our audience, any last questions for Ron or on this topic? And then I'll also mention an idea that I've seen people execute on, which is companies like unicorns. And we're usually talking about technology and software companies here pivoting into being providers. So why would they do this? Why is this a solution? Well, they may have a team and they may have capital and they may have IP and they may have but they're not profitable. Well, it turns out that tech companies lack market power in healthcare because they're not providers. They don't have licenses. And providers have market power and can choose to do things like never buy good software, for example, because they have market power. And so tech companies are frustrated and they're sick of this. And so an option available to them is to become the provider. So this is like one medical group. Did one medical group set out to build an electronic medical record, or did they set out to build a nationwide medical practice with their own electronic medical record? And that tech backbone can give them a better product. It can give them better clinical outcomes. It can give them better financial outcomes. It can make them, it's not hard to outmarket a doctor. Usually doctors are busy doing other things and they're not marketing their own medical practice well. And so you can pivot to be a provider. Usually provider organizations are service organizations that are profitable year one. So suddenly you just pivoted into a tech-enabled services provider organization that is immediately profitable, and you're not worried about running out of cash and going bankrupt anymore. So
if you can get the providers to come work for you and you can pay them enough, that's also been a problem because providers get paid a lot of money, advanced nurse practitioners, mental health, behavioral health specialists, and so forth. So some of the companies that have become multi-state providers, tech companies and so forth, I've seen their unit economics, they're terrible. And after a while, they start thinking maybe it's not a good idea to employ these providers because we have to pay them every 2 weeks.
And General Catalyst took this frustration on the part of tech companies to the extreme. And they said, we're so sick of backing promising tech companies that try to sell to providers and can't sell to providers that we're going to buy an enormous provider. And then we're going to run our tech companies inside of that provider. And that's an example of this fusion of the tech company with the provider. I call it the fusion of the turtleneck, which is the Steve Jobs visionary tech leader, with the white coats, which is the providers.
Well, Steve, quickly, let me mention that the jury on that acquisition is not out yet. VC buying a health system, what could go wrong? And also, one of the oldest adages in health tech is you've sold to one provider, you've sold to one provider. The fact that the technology may get adoption in their own health system is no indication that anybody else is going to want to use it.
Yeah. My favorite version of that joke, by the way, is once you've seen one hospital information system, then that means that you've seen one hospital information system. So, well, good. Well, I think that's all we have. That's all the questions we have. Ron, any more thoughts on Zombicorns? What's next for funded companies with growth issues?
No, I think we've covered it. I think I was in a meeting this afternoon here in New York, and we were talking about valuations, and I was with people who are not necessarily very experienced in this space, and they were talking about higher valuations and so forth. And I was telling them we've all lived through the idea of getting a high valuation that makes you feel taller and more attractive and so forth. And then you come to regret it when you need money again. That's now a noose around your neck. And I was telling them, taking a valuation which rewards you for your work, but it's not too high. It's not a bad idea. Slow, steady growth, still a safer bet to go. If you're getting valued at $179 million per employee, like uh, open evidence, a lot could go wrong in the next couple of years. So just because you have some high flyers, it doesn't mean we need to poo-poo the fundamentally sound companies in healthcare that have historically grown a little slower than their other technology counterparts, but actually achieve a good outcome at the end. They get to an exit and return capital to their investors and founders and so forth. Don't forget the fundamentals.
Yeah, thank you. That's a great note to end on. And I'll also, because you mentioned that, I'll also mention to our audience one of the funniest clips from the HBO Silicon Valley show. And during this Gen AI revolution, I feel like we're going back into that show all over again. But there's a clip from that. It's on YouTube. It's called Raising Too Much Money, Silicon Valley Show. And in this, there's a devastated founder at a bar being visited by Richard. And Richard says, well, couldn't you have taken less money at a lower valuation? And the founder is absolutely shocked. And he walks through in his mind what would have happened. And he concludes that his company wouldn't have gone bankrupt. He wouldn't have lost his job. He would have kept his girlfriend if only he uh, taken taken less money at a lower valuation. And he winds up just shocked out of his mind, having just been through the ringer himself personally. He winds up just shocked at the thought that a year ago he could have foregone or escaped this trap if only he had taken less money at a lower valuation. But who ever heard of anybody ever doing that? So anyway, well, with that, I'll wind up. So you've been listening to the Digital Health Investor Talk show with your host Steve Wardell and our special guest Ron Razmi, and we'll be publishing this show as part of the podcast series Digital Health Investor Talk show on Apple and Spotify. We would love you to listen, repost, comment, rate with a 5-star review. And our next show is coming up Wednesday, March 11th with David Shaywitz on the topic of Gen AI for patient agency and boosting health outcomes. So we look forward to seeing you there. Thanks so much. And we're signing off.